3 pre-merger SPAC stocks for November 2020. Why do I like them? Am I playing the common stock? Am I playing the warrants? Or both? All this coming up. I am not a financial advisor. This video is for entertainment purposes only. Learn to invest like a wolf at your own risk. What's up everyone? Welcome back to my channel, Wolves of Investing. My name is Donnie Nguyen and I'm the founder of Wolves of Investing. If you're new, my channel is primarily about investing in the stock market. If you want to learn how to achieve financial freedom through investing, be sure to click on that subscribe button and notification bell if you haven't yet. In today's video, I'm going to be talking about 3 special purpose acquisition companies, or SPACs, in their searching phase that I'm either invested in or looking to invest in. I'm going to be talking about whether I'm invested in the warrants or the common stock or both, and explain the pros and cons of each. And if you've been following me for a while, you know that I'm primarily a long-term buy and hold investor with most of my portfolio. These pre-merger SPAC plays represent a smaller, riskier part of my portfolio. Less than 10% of my portfolio is being used for these plays. So without further ado, let's get into the 3 SPACs for November 2020. The first SPAC that we're going to talk about is one of my favorite SPAC plays. This SPAC is called E.Merge Technology Acquisition Corporation. The SPAC units went public on July 31st, 2020 at $10 per share. The units contain 1 common stock and 1/2 of a warrant. The SPAC is focused on finding a target in the software and internet technology industries. As with all SPACs in their searching phase, the only reason I'm interested in investing in this SPAC is its management team. The chairman is S. Steven Singh. He was CEO of Concur Technologies from 1998 until Concur was acquired by SAP in 2014. And for those of you who don't know, SAP is one of the world's leading technology companies. He also served as president of SAP's Business Networks and Applications. He was a director and CEO of Docker Incorporated, which is also a very well-respected, privately held technology company. He has served on the boards of several private and public companies, most notably DocuSign, whose stock is up about 500% since its IPO about 2.5 years ago in 2018. The second person on the management team is Jeff Clark. He's the co-CEO, CFO, and a director. He served as a chairman of Orbit Worldwide, which is a very well-known online travel company. He was the chief operating officer of Computer Associates International, chief financial officer of Compaq, and he has served on the board of directors of Docker, Autodesk, and Red Hat. This guy has close ties to some very successful technology companies. And the third person on the management team that I wanted to discuss was Guy Gecht, the other co-CEO. And he is currently the lead director of Checkpoint Software Technologies and a director of Logitech International. So this is a very stacked management team, and I feel very confident that they're going to find a good target. In fact, because the management team has ties to Docker, I wouldn't be surprised if Docker becomes the target company. If that happens, I may consider turning this play into a long-term holding. I am currently invested in both the common stock and the warrants. I invested in the common stock because I was able to purchase them for less than the price of the SPAC IPO. My cost basis is $9.66. At the time I'm filming this video, the stock last traded at $9.65 per share. As with most SPACs, I'm expecting to be able to redeem these shares for at least $10 per share in the next 2 years. Unless something unusual happens, I basically have 0 downside risk. These days, a 2-year certificate of deposit pays about 1/10 of 1%. So if I hold on to this SPAC and treat it like a 2-year CD, it's gonna pay me 3.5% when I cash out for 10 bucks. And the way I get 3.5% is just $10 divided by $9.66, which is the price I paid for the SPAC. But if the SPAC team picks up a good company, I also have the potential to make a lot more than $10 per share. So I see this as a very low risk, but potentially high return scenario. The only downside is that my money could be locked up for a couple years, just like it would be in a 2-year CD. And if the SPAC does not pick a good target, then I could potentially have missed out on a better opportunity, such as a low-cost S&P 500 index fund, which has historically returned around 9.5% per year after dividends. What about the warrants? My cost basis on the warrants is $1.04 per warrant. If you watched my SPAC warrants basics for beginners video, you know that warrants are a lot riskier because they are highly volatile and there are certain situations where they can expire worthless. However, they potentially have a lot more upside than the common stock. For example, if the common stock goes to $15, the intrinsic value of the warrant goes to $15 minus the exercise price of $11.50, so that would be $3.50. So in that scenario, I have a 336% return on the warrant versus a 55% return on the common stock. Because I have confidence in this management team, I think that they can pick a target that will hit $15 and will allow me to get that 336% return or more on my warrants. At the time I'm filming this video, the warrants last traded at 93 cents per warrant. So the bottom line on this company, it is a SPAC focused on technology companies. I really like the management team, and I think that both the common stock and the warrants are currently undervalued. And before we talk about number 2, please remember to smash that like button as it really helps out the channel. And now for SPAC number 2, which is CHP Merger Corporation. The SPAC IPO'd in November of 2019. It intends to focus on healthcare-related industries in the United States. The units contain 1 common stock and 1/2 of 1 warrant. The chairman is Joseph R. Swedish. He served as CEO and executive chairman of Anthem. During that time that he served, Anthem stock more than doubled in about 5 years. He also serves on the board of directors of several companies, including IBM. Given his experience and previous success, I feel that there's a good chance that this SPAC will pick a good target. Another reason that I really like this SPAC is that they've already been searching for a target for 1 year. So most likely, a target will be chosen within the next 12 months, which means that I don't have to wait too long to achieve my return on investment. Currently, I'm only invested in the warrants. The stock price at the time that I'm making this video is $9.96 per share. If I were to invest in this stock pre-merger, I would rather wait for it to go below $9.80. That would give me a 1-year return of 2%, assuming I can cash out for $10 per share. And just like the first SPAC, there could be additional upside if a good target is chosen. I currently hold the warrants at a cost basis of 91 cents per warrant. I chose to buy them at 91 cents per warrant because they hit a recent low of 85 cents in August. So I estimated that roughly 85 cents to 95 cents would be a good price. At the time that I'm filming this video, the warrants last traded for $1.02 per warrant. And just like the first SPAC, my investment thesis on the common stock and the warrants are the same. So now on to SPAC number 3, which is Equity Distribution Acquisition Corporation. This SPAC IPO'd on September 16th of this year. It intends to focus on a target business in North America in the industrial sector. The units contained 1 common stock and 1/3 of 1 warrant. The SPAC's founder and chairman of the board is Sam Zell. I didn't know this until I read the S-1 filing, but he is widely recognized as a founding father of the real estate investment trust industry. So to me, this is just incredible to have the opportunity to invest with one of the founding fathers of the REIT industry. He currently chairs 4 companies listed on the New York Stock Exchange. The first is Equity Residential, which is a leading apartment REIT. The second is Equity Lifestyle Properties, which is a manufactured home, community, and resort REIT. Then there's Equity Commonwealth, which is an office REIT. And then there's Covanta Holding Corporation, an international energy from waste company. The first 2 REITs I mentioned have the ticker symbols EQR and ELS, and they both have superb track records. Given his reputation and track record, I'm expecting this SPAC to choose a good target. Currently, I do not own this SPAC. The common stock and the warrants just started separately trading on Friday. At the time I'm recording this video, the common stock is trading at $9.65 per share. For the same reasons I like the other 2 SPACs, I may consider purchasing the common stock at this price to get that 3.5% return with the potential upside. Because the stock just started trading and showing weakness, I may try to get greedy and see if it will go even lower, and try to pick it up at $9.50 to give myself a minimum total return of at least 5%. But what about the warrants? For now, I don't really have a good feel for how the warrants are being priced. So I think I'm gonna give it some time so that I can monitor the charts to give myself a good entry point. Sometimes the S-1 filing will mention the price that private investors paid for the warrants in a private placement. One of the tactics I use is to try to purchase those warrants at a discount to that private placement price. And this is a tactic that I came up with myself. I've never heard any other YouTuber or any other SPAC investor talk about this, so you are hearing it first on Wolves of Investing. So those are my 3 SPAC stock picks for November 2020. Let me know what you think. Drop me a line in the comment box. It's okay if you agree or disagree. I'd love to hear your thoughts and opinions. Be sure to leave a like on this video before leaving. Thank you so much for watching, and I will see you next time.